10 years is the window. Most people will spend the next decade doing exactly what they did in the last one. They will trade time for money and buy liabilities they call assets while wondering why nothing is changing. You are not going to do that because today we are giving you the 15 assets that actually build wealth. An asset is anything that grows in value or generates returns over time. This includes things your accountant would never put on a balance sheet. This is the real list starting at 15 and working our way up to the one that changes everything. Welcome to Smart Life, where we explore the best ways to build your future. We are starting with your children's education and legacy. Most financial content skips this entirely. It does not feel like an asset because it has no ticker symbol and you cannot check its value on your phone. Listen carefully to this. It is the most important lesson you will ever learn about wealth. A 20-year study by the Williams Group tracked thousands of wealthy families across generations. What they found should terrify every parent in this audience. 70% of wealthy families lose their wealth by the second generation. 90% lose it by the third. It was not bad investments or recession or inflation. 60% of wealth destruction happened because of a breakdown in communication and trust within the family. 25% came from heirs who were simply unprepared. They had the money, but not the knowledge. The money survived, but the wisdom did not. This is where most families fail. When you invest in your child's education, you are compounding human capital across a timeline that extends decades beyond your own life. We do not just mean university tuition here. A child raised understanding money and systems and delayed gratification is a more durable asset than any property or portfolio you will ever build. They will make smarter life choices and protect the family legacy. That is not just parenting advice. That is the longest horizon investment on this entire list. Trillions of dollars are about to change hands in the great wealth transfer over the next 2 decades. Most of it will evaporate because the next generation was never taught to think like an investor. While that asset pays off over generations, the next one pays off starting this year. This is about AI tools and automation. Here's the truth that nobody wants to say out loud. AI is not going to make you wealthy, but the person who knows how to use it will absolutely make you obsolete. Goldman Sachs published a report estimating that AI could automate the equivalent of 300 million full-time jobs globally. We are in the middle of the biggest productivity shift since the Industrial Revolution. The gap between someone who uses AI as a leverage tool and someone who does not is widening every single month. In 10 years, that gap will be a canyon you cannot cross. Businesses not using AI will be like businesses not using the internet today. The asset is not the technology itself. You do not need to buy tech stocks to benefit from this shift. The asset is your ability to orchestrate AI and be the human intelligence directing automated systems. You become the person who turns 8 hours of work into 45 minutes. You become the person who runs the output of a massive team from a single laptop. Think about what that means for every other asset on this list. AI does not replace your portfolio. It accelerates it by giving you back the one thing that no amount of money can buy more of. It gives you back your time. It gives you back your time. Most people think the only way into business is to start one. This brings us to small business acquisitions. When most people think about getting rich through business, they picture starting something in a garage and grinding for years before something finally works. We respect that path a lot, but the wealthy take a different one that almost nobody talks about. They buy businesses that already work. Right now, there are thousands of profitable small businesses generating consistent cash flow. Cleaning companies and niche software tools and local service providers are owned by people who want to retire. Most of them never appear on any public market. They are sold quietly between people who know where to look. Most of these owners just want their businesses to live on, so they are willing to do seller financing. This means they do not want all the money up front. You can take over their business and pay them off as you operate it. Acquisition multiples on small businesses run 2 to 4 times annual earnings. A business generating $200,000 in annual profit might sell for $600,000. If it maintains that profit for a decade, you have made $2 million on a much smaller initial investment, and you still own the business. You can finance it partly with the business cash flow. After you digitize it and add AI, you hire someone to operate it. You just grow it past where the previous owner stopped. This is the most underrated path on this list. It skips the startup phase entirely and buys you cash flow from day one. Millions of baby boomers are reaching retirement age and many own businesses they need to sell. You do not need to build cash flow when you can buy it. Not every asset on this list is about generating returns. Some of it is about protecting what you have built. This is where alternative stores of value come in. Let us be precise about what this is and what it is not. Gold and Bitcoin and fine art are hard finite assets that exist outside of traditional banking systems. These are not vehicles to get rich quickly. They are insurance. Every currency in history has been debased. Governments print money and inflate away debt while quietly eroding the purchasing power of savings. When they print money, they are taking value from everyone who holds cash. The people who benefit are the ones who own stores of value. This is not a conspiracy theory, it is just monetary history. It is done by design and built into the financial system everywhere in the world. Gold has preserved wealth for thousands of years because it cannot be printed into existence. Bitcoin is the modern version of that principle because it is mathematically finite and decentralized. We are not here to debate its daily price fluctuations. We are simply saying that an asset with a hard supply cap and growing institutional adoption deserves a considered position in any serious portfolio. The smart play is the proper allocation. We are talking about 5 to 10% of your investable assets. The goal is not to get rich from it. The goal is to ensure you are never fully dependent on a system that can dilute your savings overnight. This part of your portfolio protects everything else on this list. Next, we have farmland and commodity land. Years ago, Warren Buffett bought a massive farm in Nebraska. He does not farm it himself, he leases it to a farmer. Every year, the farmer pays him rent, and every year the land appreciates. The food it produces becomes more valuable as the global population grows. Bill Gates is currently the largest private farmland owner in the United States. This is not a coincidence. Productive land has a characteristic that almost no other asset shares. You cannot manufacture more of it, the amount of farmable land on Earth is fixed, and the demand for food increases every year. Historical data shows that U.S. farmland has provided incredible average annual returns. It often outpaces major stock indexes over long periods. What makes farmland genuinely different from stocks is the stability. The floor on farmland does not collapse the way the stock market can. You do not need to buy a massive farm to participate. Agricultural real estate investment trusts exist today. Fractional ownership platforms have made this accessible at entry points that did not exist a decade ago. This is actually a secret edge for everyday investors. You can look at rural areas where land is still relatively cheap. The patient investor who buys land and holds it for 10 years almost never regrets it. The next asset is where extraordinary returns live. This is private equity and angel investing. Private equity has historically outperformed public markets significantly. That is why everyone wants to get into private equity. The wealthy protect their deal flow more carefully than their money. When a company becomes available on the stock exchange, the early investors have already multiplied their money many times over. By the time you can buy it through your brokerage account, the extraordinary returns are gone. Private equity and angel investing is how you get in before the valuation spikes. Angel investing means putting early capital into startups in exchange for equity. Most bets will fail, but a handful will succeed enough to make the portfolio extraordinary. The math works when your judgment is sharp and your investments are diversified. Private equity means investing in established private businesses that are growing toward an exit. This is not beginner territory. It requires access and the emotional resilience to watch some investments fail. For those who build this capacity over the next decade, the wealth creation potential is unlike anything in public markets. The first step is simply getting into the rooms where these deals are discussed and networking with the right people. This brings us to your reputation and network. The biggest deals in the world do not happen through job boards or cold pitch decks. They happen through a phone call between two people who trust each other. They know they can do business together safely. Someone will say they have a deal that is perfect for you. Your network is not your social media profile. It is a living and compounding asset that generates access and opportunity for as long as you invest in it. You can tap into a good network for extra income anytime you need it. Just like any other asset, it depreciates if you neglect it. Your reputation is the foundation of that network. It is the answer to the question every person asks before they introduce you to someone important. They need to know they can stake their credibility on you. Every promise you keep builds your reputation. Every commitment you break erodes it. In 10 years, the person with the right network and an impeccable reputation will access deals that money alone cannot open. We have seen people with modest financial wealth open doors that billionaires knock on because their reputation was irreplaceable. Build this deliberately and spend time maintaining your connections. Guard your name like it is your most valuable possession because it truly is. Next, we have digital assets and audience trust. For most of human history, distribution was the main bottleneck. You could not get people to know that you exist. Now you can. The modern bottleneck is that everyone is fighting for attention all at the same time. A digital asset is anything you own online that generates traffic or revenue. This includes a website with strong search rankings, or a video channel, or an email newsletter. When you own the distribution, you hold one of the most valuable assets in the modern economy. People come to you rather than you paying to reach them. The creator economy is massive and growing rapidly. Media provides unlimited leverage because you create something once and sell it endlessly. A niche website generating consistent monthly visits can be sold for a massive multiple of its revenue. A newsletter with engaged subscribers generates advertising income and product sales every single week. These assets are built with more time than money. If the content is genuinely good, they compound through content libraries that keep generating traffic for years. It is getting crowded out there, so you have to differentiate yourself. You need true fans who are willing to buy from you because they trust you. True compounding begins the day you start building that trust. This takes us to intellectual property. You own the idea itself and not just the audience. You write a book once and sell it 1,000,000 times. You record a course once and people are still buying it 10 years later. You file a patent and every company that uses that idea pays you a licensing fee forever. Intellectual property is the only asset class where the cost of delivering one more unit is practically zero. Ideas are incredibly valuable but very cheap to distribute. Every other asset on this list requires additional capital or maintenance to scale. Intellectual property does not. The greatest portfolios were built by people who understood their knowledge deeply enough to package it and protect it. Authors and musicians continue to earn royalties long after they stop working. You do not need to be a celebrity or an inventor to create something valuable. A well-positioned course in a high-value niche is intellectual property. A software tool that solves a specific problem is a perfect example. These are assets that everyday individuals build all the time. The question is whether you are willing to do the work to package your knowledge. The next two assets work while you sleep. They require your patience rather than your presence. We are talking about dividend stocks. This is the mechanism of getting paid for doing nothing. Dividend stocks are shares in companies that distribute a portion of their profits directly to shareholders. If you own stock in a major profitable company, a percentage of their earnings shows up in your account automatically. The real game is not just collecting the dividend. The real game is what happens when you reinvest it. Every dividend reinvested buys more shares. Those new shares generate more dividends, which buy even more shares. This is the compounding flywheel that transforms a moderate investment into massive wealth over a decade. A portfolio of blue-chip companies with long records of consistent dividend growth is the bedrock of generational wealth. It requires almost no active management. It provides quiet and deep satisfaction that comes from pure patience. If dividend stocks are the quiet engine, then index funds and ETFs are the autopilot. Over any 15-year period, the vast majority of professional money managers underperform the average market index. The majority of highly paid experts lose to the average. Let that sit for a moment if you are trying to handpick individual stocks. This is the market working exactly as designed. An index fund groups the top companies together so you can invest in the entire market at once. When a company does poorly, it is automatically removed and replaced with a better performer. It operates like a self-cleaning machine. A steady investment in a broad market index fund over 30 years grows exponentially. There is no stock picking or market timing required. Index funds give you diversified exposure to entire markets for minimal fees. They are the most reliable wealth-building vehicle ever created for everyday investors. They should be the consistent compounding floor underneath everything else in your portfolio. The best time to start was years ago, but the second best time is today. Now we enter the final four assets that have created more millionaires than anything else. We start with income-producing real estate. There are 5 clear reasons real estate is a wealth machine. First is leverage. A bank will lend you the majority of the purchase price. This leverage multiplies your return on investment. Second is that someone else pays for it. Tenant rental income covers your mortgage and generates positive cash flow. Third is the tax code. The government provides massive tax benefits and deductions for property owners. Fourth is inflation. When inflation rises, your rental income increases, but your fixed debt stays exactly the same. The real value of your asset grows while your debt shrinks. Fifth is time. Every mortgage payment builds your equity. Real estate held for a decade rarely disappoints a patient investor. You do not need to buy a mansion. One well-chosen rental property in a growing market is where most serious portfolios begin. You buy one and stabilize it and use the equity to buy the next. This asset takes leverage to its ultimate expression. It is your own business and equity. When you work for someone else, the relationship has a ceiling built into its structure. You trade your best hours and ideas for a fixed salary. When you are exceptional, your employer benefits the most. When you build your own business, it works differently. You benefit directly from your own exceptional effort. When you build it correctly, it runs whether you are present or not. Eventually, someone might offer to buy it for a life-changing sum of money. The wealthiest people in society are overwhelmingly business owners. They chose a vehicle with no artificial ceiling on their earning potential. You do not need to build a billion-dollar tech startup. You just need to build something that generates reliable profit. You build something real and systematize it so it runs smoothly. You can enjoy the cash flow for life or take the exit and invest the capital. Your business is your most powerful financial vehicle. The top 2 assets require a very real conversation. Number 2 is your personal health. None of the other assets on this list matter if you are not alive and sharp enough to manage them. Your health is not just a lifestyle choice, it is the operating system that determines the quality of every decision you make. People who exercise regularly earn more money and sleep better. They make measurably better financial decisions and live significantly longer. This gives their investments decades more time to compound. The return on investment for physical health is highly calculable. Studies consistently show that healthier individuals have vastly longer life expectancies. Physical health is a high-yield asset that compounds over time. Fit and active individuals are more likely to be promoted and earn higher incomes. Invest in your health the exact same way you invest in your financial portfolio. You need consistency and a long-time horizon with no expectation of overnight results. The compounding is quiet, but more important than anything else you will do. The final asset makes everything else on this list possible. It is your high-income skills. Everything on this list requires capital to start. Capital comes from your income. Sustained income comes from skills the market values highly and cannot easily replace. This is the seed that determines how fast everything else gets built. A person who earns a high salary can invest 12 times more capital than an average earner. That means 12 times faster compounding and a massive financial foundation. The highest leverage financial decision you can make is to increase your earning capacity. A high-income skill is one where the ceiling keeps rising with your mastery. Sales and software development and leadership are great examples. In the next 10 years, the highest earning skills will require human judgment and creativity. They will be amplified by technology but cannot be fully replaced by it. Do not treat skill development as something you will do later. It is the core financial strategy. Every year you invest in becoming world-class at something valuable will pay you back for the rest of your life. That is the complete list for your financial future. We covered everything from children's education and AI tools to real estate and high-income skills. The wealth gap is no longer an information gap. You have all the information you need right here. The real gap is the action gap. It is the distance between knowing what to do and actually doing it. Do not just close this video and change nothing about your life. Pick 3 of these assets and start building them over the next 90 days. Take real action and watch your life transform. Thank you for watching Smart Life today. Please make sure to like this video if you found it valuable. Subscribe to the channel so you never miss an update. Leave a comment below telling us which asset you are going to build first. We will see you in the next video.